Mayuresh Joshi also joins us and we are in conversation with our technical experts. Markets are just flirting with this 100-point range today, and metals is where the outperformance now seems to be real. Mayuresh, what is your sense? The last hurrah in the market is still left before the year ends?
Afternoon, Nikunj. No, that can be a high possibility, and you can never rule it out because there is every scope before the third quarter earnings start coming in, before Trump assumes his presidency, that there might be a last spurt as far as the markets are concerned. But beyond December, I think it will all boil down to how earnings will play out. And earnings still expected to remain soft in the Indian context. And let's add geopolitics and what Trump probably does in the initial days of the presidency as well. Let's also not forget, Nikunj, that we'll also be heading into the budget season as we head into next year as well. And therefore, expectations from budget will start running high for the markets itself. So again, expecting a range-bound trade as far as the markets are concerned.
Range-bound trade at the index level, but what within that construct do you think might outperform for the next couple of months? Any sectors that you can call out which might just do better than the rest of the pack?
Afternoon, Anisha. So again, I think IT has done a stellar show, but in our opinion, I think the valuations and the base structures are a tad bit on the higher side. So I think any earnings disappointment for the sector as a whole might actually lead out to significant amount of profit booking. But nevertheless, I think going by commentaries on what Q2 has been, at least a large part of the mid-cap IT companies sound very optimistic in terms of revenue growth, margin performance. The second element in terms of the capex spend expected from the government in the second half is expected to be significant enough. And therefore, I think select sectors within infra and manufacturing, specifically, I think EPC players, waste and water management companies, should probably see a significant and incremental benefit coming in terms of significant order flows with better margins. Again, cement as a subsector should continue doing well within terms of growth, and the sector can continue consolidation that is happening for the industry as a whole. The input costs which are moderating at this juncture, leading to better EBITDA and better EBITDA per ton. Last but not the least, certain names as we're looking out for within the pharma name, or the pharma space itself, should continue doing well as a hedge in terms of so I think a tad bit of flavor in terms of how earnings are played out on a few of these sectors should also act in favor of agrochemicals. Numbers have been very good in Q2 with good reservoir levels, expectations of a better Rabi harvest this time around. I think a lot of the domestic agrochemical players should continue posting reasonable set of numbers as we head into Q3 and Q4.
Is cement finally out of its hibernation? Because this is one sector which frankly has done little in last couple of years. And Mayuresh Joshi, little bit of shakeout at your house. Please fix the light. Brightness, darkness, skin is shaking. Okay, Mayuresh, will come to you. Then Mayuresh hopefully will have a better light.
So in terms of cements, we've started seeing say the largest one, Ultratech, knocking at that 12,000 mark. A lot of other names have started basing out. So Shri Cements has been sideways for the last 3 years, is knocking at that 28,000 mark. So starts look interesting across the board. Even the smaller names you've seen some breakout. Would continue to like say Dalmia Bharat and Ultratech Cement in the two names. Dalmia Bharat has made multiple attempts around 1950 for the last 6-8 months. So one smaller name and one large name.
Kunal, the month belongs to cement. Will the quarter also belong to cement? And will the coming quarter also belong to cement?
Yeah, the few of the names are looking quite attractive. Ramco Cement is something which I had seen on the charts. That's a very interesting name. The stock is coming back into a multi-year breakout highs. I think 1100, 1080 was the previous highs for the stock, and it's now coming very close to that. The recovery has been quite strong. The volumes have been one of the stronger volumes the stock has seen over the last many years when it's gone to a price consolidation. Ultratech Cement, of course, is one of the strongest name from the pack. Then even Shree Cement has been recovering quite well. The stock has come back from its sub 200 moving average range to now above the 200 DMA at 26,000, 27,000 plus levels where it's trading right now. So the pack is looking attractive. There are many stocks which have moved up towards closer to the life high levels. And I think that generally is a very strong indication that the sector is getting to a revival. And we've hardly seen cement stocks getting to a synchronized price action move, and that too on the back of higher volumes. Most of the times we've seen cement stocks getting associated into a more of a price range, a very dull kind of a price action range. But this time around, the volumes and the activity is quite strong. So expecting that this trend should continue.
Okay, expecting the cement pack to continue the outperformance, that's the word coming in. During the day, there was that additional news flow regarding the EMS companies getting a bit of a boost, especially when it comes to the laptop imports, etc. We'll try and get Sumita shortly to talk to us a bit more about that. But in the meantime, Mayuresh, if I can take your view on the electronics manufacturing companies, quite a few of them had run up quite ahead of fundamentals. Yes, the visibility is strong in terms of growth, but don't you think it's priced in?
Oh, absolutely. I think valuations are rich. No two ways about it, Anisha. I think take any company for that matter, Keynes, Avalon, Sigma HGS, even Dixon to a certain extent. So to a large extent, I think the expectations in terms of the PLI scheme working in their favor, more orders expected to come their way. They're tweaking a large part of their portfolio towards the ODM part. Now, obviously, we all are aware that the ODM part carries better margins, considering to outsourcing that these folks do. And therefore, I think as a percentage of ODM, as that increases, that will have a significant accretion in terms of reported EBITDA over the next few years. Secondly, I think in terms of their backward integration and rationalization of supply chains, obviously that benefits to a large extent both their gross margins as well as EBITDA margins going forward. And obviously, I think the China plus one that we are speaking about, I think a lot of managements in the results that have just gone by, and even in the previous quarters, have hinted that this is a possibility that will come through. Last but not the least, let's not forget that semiconductor as a space and that the government push through is also happening. So beyond the PCBs, the printed circuit boards that these folks do, I think a lot more specialized work can probably happen as far as semiconductor chips are also concerned. Obviously, I think the entire market size is actually expected to triple from almost 20 odd billion to 60 to 80 billion dollars over the next 5 to 6 years. So there is sufficient amount of growth headroom available. But at the current juncture, looking forward in the next 2 years, looking at the best earnings case scenario, I think they're priced to perfection. So anybody holding it can hold on. Fresh investors will need to wait for it.
So then cancel it, please.
So Naresh, let's look at another sector which in a sense has not participated. Could it make a comeback? And that is insurance, Naresh.
So that's a tough one to make a comeback purely for the fact that the correction has been really sharp in some of the names. So when you see such a large correction, say a 1900 rupee SBI Life, which was holding strong for the last many months, has corrected back and gone back to the gone below the previous breakout point also. That would imply we could go sideways. Same is the case with the HDFC Life. The stock corrected from the same highs of 2021 and down. So in this case, we would get a much more longer period of sideways consolidation. The only name which still looks okay is Life Insurance Corporation of India, because that's already been in the sideways zone for a long time. So LIC of India would be okay, but the rest of the private names could be in a consolidation mode and keep facing selling pressure on every rise from it.
The point that Mayuresh was making regarding some of these, export-oriented names, whether it's manufacturing of electrics or otherwise, that's a question we did pose to Harsha Padhya as well of Kotak AMC as to within IT, pharma and textile, all three have different tailwinds and headwinds to really talk about. What is he preferring within these three? Hear out his take.
On the pharma side, yes, I agree that the latest development where there has been a pushback in terms of the timelines for Biosecure Act is a very short-term negative. However, from a medium-term perspective, we still believe that that opportunity is very large and can drive earnings for many Indian pharma companies. It's too early to say that a similar large opportunity could be in front of textiles at this point of time. Yes, the disruption that we are seeing in Bangladesh is probably an opportunity, but we need to see how that situation evolves over a period of time and how much of that will benefit Indian textile companies. So at this point of time, I wouldn't really jump into textile sectors because of the unrest in Bangladesh.
That's a take coming in from Harsha Padhya. Take a look at CE Infosystem. It's now inched up a gain of around 17%. So quite a bit of rally on that stock. Mayuresh, do you track this one, closely, that entire flip-flop and the corporate governance red flags that was raised, now the company reversing part of its decision?
No, Anisha, unfortunately, we don't. I mean, at least I don't track. Sorry.
At all. Yes, a stock maybe which has not been well tracked but has been fairly active of late, so just watching out for that big up move on that one. Kunal, would you want to hazard a take on the charts of this one?
Map India?
Yeah.
Yeah, I think I was looking at the charts for the stock in the recent past, and there was a point when the stock had risen above its long-term moving averages towards 2600 levels in the month of June, July. From there started a phase of correction. The stock corrected 1000 points towards 1600 mark, and it's now trying to come back to that midpoint of this 1000 point range, say closer to 2000 2100. So my sense is that after this price action move which is seeing today, the stock should be able to come back towards 2000 to 2100. That's the midpoint level, and that's where I would probably believe that the stock should consolidate. So I would expect that the stock should have a follow through up move by at least another 100 to 150 points further.
The other talking point in the market, Mayuresh, is what's happening to the auto sector, right? I mean, we've all seen those headlines come in the week gone by that the companies are looking at taking price hikes of anywhere between 1 to 5%. But we just spoke with FADA this morning and they are still maintaining that there is a situation of supply glut when it comes to the inventory. And we'll try and play that soundbite very shortly. And they are requesting the auto OEMs to perhaps not take those price hikes. Let's quickly listen into a slice of that conversation. Mayuresh will discuss the auto sector in detail.
The passenger vehicle segment seems to be the segment which is right now suffering with a glut in terms of excess inventories. We are at about 65 days. This has come down by 10 days compared to the previous month, but this has to really come down. We are having an optimized inventory level and image in mind at about 21 days. That would be an optimum inventory levels. So right now the stocks are high. Because the stocks are high, there are also great offers available. So there is a good chance for us to liquidate this stock because customers have never seen before discounts and offers on passenger vehicles. I completely understand what OEMs do because for them also the price hikes are inevitable because of the cost of various inputs, inputs going up, like it could be labor, it could be material, all these things keep going up. So it is absolutely important that they raise prices. But given the current situation, they might have to probably optimize this or probably delay it a little bit because there are already high inventories, there are high discounts going on. So it is counterintuitive to go and increase prices again. But price increase is a reality which all of us understand in the industry. But I would really request the manufacturers to think about it because this would not be a great time to increase prices given the factors which are prevailing.
20 minutes to go and then we'll get the market final rates. It's turning out to be like an okay day, just like a passing day where you picked it up from where you left on Friday and then you say, okay, nothing big in terms of a move, no large news flow. But Reliance has reversed. Naresh, several times in last 10 days, Reliance has done the job of taking the markets higher. Today it is back to what it has done. It is dragging the markets lower.
So Reliance, if we look at the overall picture for the last 4-5 months, this has been the biggest drag on the Nifty from a high of 1600. Even now it's at 1290. So out here, it's been the biggest underperformer. On the recovery, 1300, 1350 has been a resistance. 1350 was the previous support which broke. So for now, it seems like making a base out here. We made a bottom around 1230 odd levels. So till the time it holds about 1270 levels, the bias would be positive. It could again go back to 1350, but still remains the relatively weaker stock in the whole large cap heavyweight space. But for now, I would expect 1270 to hold and 1350 to be a resistance. This could be a range bound move for the next at least a couple of weeks on Reliance.
Mayuresh, any special reason why Reliance is underperforming? I mean, first everyone attributed to ETF selling, money is moving out of India, so Reliance had to suffer. Then everyone said the debt is going higher. But despite the fact that markets have made a comeback, Reliance is gaining less and falling more.
So, Nikunj, I think 2-3 reasons. One, again, on the retail side of things, specifically when it comes to Jio, you've seen the subscriber loss that has probably happened for both Jio as well as Airtel. And BSNL has been surprisingly adding subscribers with their launch of their 4G and the 5G SIM as well. Obviously, with ARPU increases that have probably happened, what kind of an incremental benefit does take place is something like the street will like to see. Obviously, with the festive season around, Reliance Retail should bounce back sequentially. And therefore, I think the retail businesses should have a steady state going ahead. Some offsetting factor, as I said, as far as the Jio business is concerned, in terms of the subscriber and the SMS market share. As far as the upstream stroke petchem business is concerned, obviously it is still patchy in terms of demand supply dynamics, and specifically the petchem business, where downstream product pricing as well as the spreads across various products are still on the lower side, which probably means that petchem might actually be a drag as far as the recovery is concerned. Obviously, as far as Singapore GRMs are concerned, because Reliance has optionalities in terms of different feedstocks, it might be a tad bit better. But again, I think that might be a little bit, again, softer as we head into the next 2 quarters as well. Obviously, the new energy businesses, how do they ramp up, specifically in terms of project completions and therefore utilization levels over the next few quarters is something to be seen. So I think the street probably expects softer numbers coming through from most verticals of Reliance going forward. And that's a large part of why Reliance is probably underperforming.
That explains partly why the underperformance is there in Reliance. But there is a very interesting note today from Kotak Institutional Equities, which is talking about the impact quick commerce is having on D-Mart, because they for now haven't got into the quick commerce rate. But in terms of prices, they're still very, still ahead as far as, the prices are concerned versus the quick commerce company. Let me take it across to my colleague Snehi to get better understanding as to what exactly is the thesis of the report, because they continue to maintain the sell stance on the stock, but the pricing differential is something that they're talking about. Snehi?
Well, absolutely. So this is a report coming in from Kotak Institutional Equities on the comparison between D-Mart and quick commerce. They've retained their sell rating on D-Mart. They've also cut the target price on D-Mart to 3,450 rupees compared to the earlier 3,650 rupees. However, they've retained the same store sales growth estimate for D-Mart at 8%, but they're also noting some downward risk on this front as well. They see more impact from quick commerce on D-Mart in the very near term. They believe that quick commerce companies have become more aggressive when it comes to their pricing strategies, and on the back of that, because they are offering more discounts, the gap of pricing between quick commerce companies and D-Mart has been decreasing very consistently. And this is also on the back of the fact that D-Mart does not provide home deliveries. Quick commerce is now coming down in terms of prices, and they also provide instant home deliveries, which is something that makes quick commerce more attractive compared to D-Mart at present. They've also trimmed their FY25-27 EPS by 1 to 2% on the back of this, and they believe that disruptive quick commerce pricing may also negatively impact D-Mart's volumes going ahead. They say that D-Mart's dominance when it comes to a low-cost, value-based seller is now being challenged by the quick commerce space. Also, what they're not liking is D-Mart's most profitable stores are also in areas that are thickly dominated by quick commerce as well. The current run rate of store additions indicates that the new store additions may lag versus expectations earlier. And on the back of that, they've trimmed their store addition target also for FY25, 26 and 27 to 50, 60 and 70 respectively, compared to 55, 65 and 75 earlier. They also believe that a couple of quarters ago, quick commerce was not such a big threat to D-Mart, but now that is changing, and aggressive pricing by quick commerce platforms could drive some of the value-focused customers away from D-Mart to quick commerce companies. Very quickly, if you compare Zepto's Super Saver compared to D-Mart stores as well as D-Mart Ready, the price difference now has come down to almost a minimal, because for grocery staples now that's only at 5.2%, packaged food and dairy at 7.1%, home and personal care at 11.7%. You have other household products at 14%. On an overall basis, it's just a 9.3% difference between what Zepto offers and what D-Mart offers. So that gap is consistently coming down, and that is something that they're not liking for D-Mart.
So Naresh, what is the verdict here? D-Mart, V-Mart, Zomato or Swiggy? Which is best one to buy?
I would go with, say, something like a Swiggy. Avenue would be an avoidable stock, seeing my own preferences, how we've shifted. So in that case, Swiggy is something where there is a lot of, say, volumes post-IPO, would keep a stop loss below the recent lows of the last 2 weeks.
Point taken. In fact, let's take some of the BTSC trades now. Kunal, what's the buy today, sell tomorrow idea?
So I'll go with a couple of buy calls. Cummins India is the first one which I'll suggest as a buy. A very classic risk reward. The stock has come back towards a key support point of 3,500. So keeping 3,460 as a stop loss, would look out for targets in the range of 3,600. And the second would be a buy on Pidilite Industries. After 4 days of price correction, the stock has formed a bullish hammer pattern on the daily charts in terms of candlestick. So would look out for targets in the range of 3,220. Stop loss at 3,120.
Okay, point taken. Naresh, what's your top recommendation when it comes to a BDSC trade?
So first would be a buy on Muthoot Finance, showing a lot of relative strength on verge of a breakout to new all-time high. Stop loss at 1975, target price of 2040. Second is a buy on Voltas, which has given a range breakout today. Stop loss at 1740, target price of 1785.
Top BTSC trades coming in. But Naresh, before we let you go, if we had to ask you top recommendations from you right now, which sector, theme or stock that comes to mind?
I'm looking at the textile space as such, personally biased, I have a larger allocation here. So there are a lot many choices, but textile as a sector looks interesting.
Naresh, the question to you now, the similar question, the top recommendations, sectors, themes or stocks?
So BFSI, clearly, Anish, I think we've seen the policy go by. And now I think how the numbers have played out should positively reflect in terms of the ensuing quarters as well. Last month, I think for the first time, deposit growth exceeded credit growth. And therefore, I think Federal Bank remains on our watch list within the mid-cap private names. Strong set of numbers as far as NI is concerned, NIMs are concerned, as well as profitability is concerned as well. Fee income was also very, very steady. The kind of remittances growth that they have been exhibiting should continue growing in the next few quarters as well. And therefore, I think both from a valuation perspective, both from an ETSRS rating perspective, and a valuation perspective as well, Federal Bank probably looks well placed. Similarly, in the PSU space, Bank of Baroda, strong set of numbers. Management sounds very, very confident in terms of maintaining their NIMs. Obviously, in terms of how their credit deposit ratios are playing out and the legacy accounts that they probably carry in terms of deposit growth, that should have a steady state show as well. Provisioning is extremely high at this juncture, and therefore any write-offs that they've done in the previous quarters, which a lot of banks have alluded to, should probably start reflecting in terms of better profitability. So, within the agrochemical space, Paradeep Phosphates is something that we are keeping on our watch list as well. Strong growth that has got exhibited. They are expanding their backward integration facilities and capacities. Debt has come down quite significantly on their books. Farm gate prices remain strong. Input costs have probably come off quite a bit. And therefore, with the expectations of a better Rabi season around, Q3, Q4 should also be relatively better. And therefore, the next few quarters, including the next Kharif season, should actually play out well as far as these dynamics are concerned. So I think a few of the banks, as I said, a few of the agrochemical names like Paradeep Phosphate or even Sumitomo Chemical names, these stocks should continue.
Point taken. So that's the view coming in. Just before we wrap up the day and I hand it over to Snehi, let me just ask you, Kunal, a quick question on the IT sector, because it does seem like HSBC has come out with a fresh note and they have upgraded the likes of Infosys and LTI Mindtree, but downgraded Coforge, TCS, etc. Any view that you have within IT, the top bet and the worst bet?
Well, in fact, Wipro is one of the strongest names so far from the large cap IT names. The stock has confirmed a breakout multiple times over the last 1.5 week in terms of the previous swing highs. The previous highs for the stock in terms of adjusted price value was around 280, 285. That's been broken. The stock is up higher, margin of 20-25 points further from those levels. So that's one of the strongest name so far from the large cap IT space.
Okay, ending the day close to the highest point of the day. But with that, let me thank all of you gentlemen for joining us.
If you like this video, then like, share and subscribe to ET Now.